And the last one is traveling outside the United States. If you're outside the U.S., the collection stops. Now, a lot of people don't know about this, okay? So most people don't, this one a lot of people don't know about. So these are the things that keep that clock running, all right? That's our 10-year statute, okay? Allowable expenses. Let's talk about this for a minute. When you have, regardless of how much money you owe the IRS, regardless of the amount, let's say a person has a balance of $50,000. You have a $50,000 balance, okay? And your income is $6,000 a month. And your expenses are $5,900 a month. You have a difference of $100. This is how much money you're going to pay the IRS monthly. You can owe $80,000, $90,000, $100,000, $1 billion. This is how much money you're going to pay. Where they fight you is here. Your allowable expenses. You have to prove it. For example, in New York or in every state, the housing allowance it depends on where you live. In other words, housing is an expense that the IRS allows, but they may cap it based on where you live. Your car expense, if your car is $1,000 a month, the IRS is not going to allow you to deduct that. Typically, the car is around $500, depending on the area in which you live. So the point is, these expenses are the key to your solution, but you have to be able to document them, and you have to be able to prove that you are paying the expense, and the bill is in your name. Now, a lot of times, bills are not in your name because you may have a credit problem. So we just have to explain that to them. As long as it's being paid, and you're paying it, we fight them, and this is how much money you would pay. Now, here's the question. Let's say there's 3 years left on the collection statute. How long do you pay this $100? 36 months. In other words, if you owe 50 grand, you have $100 left over, right? You're going to pay them $100 a month until the statute runs out. You missed it. There's a collection statute of 10 years. Regardless of, when you owe money to IRS, they have 10 years in which to collect the money from you. After the 10 years is up, it's like a balloon. Really? Yes, ma'am. Yes, ma'am. So, and what we talked about that being, that's not always the solution, but it's a part of solving the problem. So just to go through this, you have $100 left over. 3 years left, you're going to pay them $3,600.
So it doesn't matter how much interest that they put on it or anything?
Excellent question. All of the interest, the penalty, all that stuff goes away.
After the 10 years?
Yes, ma'am. It goes away. I had a client come in my office. Yes, sir.
How do you know the start of your collection?
That's a very good question. That's a good question. When you file your return, the IRS, it's about 6 to 8 weeks after you file. That's when the collection starts. But what we do, we pull down a transcript, and the transcript tells us that date. Now, on the transcript, it's not going to tell you when the statute expires, because it's like a little secret. Years ago, when I would call the IRS and ask about the statute, they would hang up the phone. They've hung up on me. They don't do that now. They hung up the phone.
So let me ask you this. So if you renegotiate your tax payment, does that restart the 10-year statute?
Good question. It does not. Okay. What starts the 10-year statute is filing an offering compromise, filing for an appeal. But now, sometimes these are good things to do because you need to protect yourself. Okay? Bankruptcy. If you file for bankruptcy, you stop it. If you travel outside the country, and if you give them permission by signing a form called a Form 900, it's called a waiver. Right. That if you ever receive a waiver, you need help. Do not sign it. Okay. Call for help right away. Because what you're doing, you could be adding additional 5 years to that 10 years. Okay? So definitely call. Now, there's a reason they want to do it, but you have rights. These are the rights that we have. Okay? So the allowable expenses and the 10-year statute are working together where you pay $3,600. Okay? So you put these rules together. We want a client to have an affordable plan, not a plan that the IRS wants you to have. Some people come in, they're paying $2,000. I mentioned earlier, the doctor's paying $4,000. You should see the stress in his face, his veins in his eyes when he was sitting in the office with his wife. He could not afford to pay $4,000. But the agent told him, you must pay it. Why? His statute was running out, and they wanted to get as much money as possible. But what we did, we broke down what he could afford to pay. We wound up doing an offering compromise, and he saved. I believe we went from $400,000 to $30,000 in terms of an offering compromise for him. So we stopped him from paying $4,000 a month. We want to have a plan that's affordable, because you want to have an intelligent relationship with them. Because if you have a plan that's not affordable, guess what? You're not going to pay your current taxes, and you're going to wind up having a new problem. So that's what we tell them. We say, we can't pay your current taxes, so we need to reduce that amount. You can update your finance. You mentioned if you go back to them and change your financials. You update your financials if things change. If you have an agreement with the IRS because you're working 2 jobs and you lose that second job, we have to go back and renegotiate, because now I can't afford to pay what I was paying before.
So you didn't get to tax liens yet, right?
We did.
So what happens if they have a lien on your house?
I'm dealing with that right now with a case. When there's a lien on your house,
Is that the 10-year statute still applies?
it does.
Okay.
But you have to have it removed. In other words, once they can no longer legally collect, the lien is supposed to be removed. And sometimes they do it without you doing anything. But what we do, we call a lien unit and expedite it, okay? When they cannot no longer legally collect, that lien it's over, okay? Now here's the thing, the IRS can sue you before the statute expires and get more time. They can get a judgment. But they normally don't do it.
Is it a waste of time for them, or?
It's money, it's cost. They feel that you really don't have the money, or if you've been ignoring them and not being nice. So you want to make sure that you're having a conversation. Do not ignore the IRS. Don't ignore them. There's a solution. Every case, there's a solution. Every case, there's a solution. We'll find it. So we don't want to ignore them. So we're talking about how to defend yourself again. Now, the offering compromise, this is our goal, and we get a lot of these, accepted offering compromises, okay? I just backtrack a quick second. We have a new client. A client came in actually 30 days ago, okay? He has a restaurant up in Albany, and he owes the IRS, I'm thinking, $200,000. He's been through a big mess with them. He had another person representing him. So when I called the agent was just like, he didn't want to speak to me. He was like, look, this guy's a bum. I'm getting ready to try to put him in jail. He was good. I just listened. I said, okay. I said, all right. I said, tell you what, I'm new to it, right? I said, why don't you allow us to investigate and come give you some new financials? And he says, I'll give you 30 days. And he said, if you don't have the financials in 30 days, I don't even want to talk to you. I said, no problem. So the financials would due, I think it was today. They would due today. So this guy received a levy on his merchant, his credit card machine. They levied his credit card machine on the 1st of September, okay? So I'm looking at my notes, and I said, why would he levy this? The 30 days are not up. What happened, right? So I called the guy, and I told him, I said, listen, I said, you sound like a straight shooter when we were on the phone. I mean, you gave us 30 days. He said, Mr. Muhammad, I looked in my notes. You were correct. I stand corrected. I'm releasing the levy. Took 2 seconds. The point is, but we sent him the financials. And so he says to me, he said, listen, I know you have a busy tax season with the corporate deadline next week. I'll call you after that. Sorry for the inconvenience. Now, this is a guy who wouldn't want to talk, because this man has been going through this for quite a while, different agents. But it's the approach and keeping your word, okay? But this is the goal. The offering compromise is a complicated process, but it's doable. So I'm going to try to explain how it works. But it is complicated. And it's a formula-driven solution. It's not about negotiating only. It's about do you fit, okay? So here's basically how it works. This is basically how it works. There's 2 parts to it. The calculation has income and assets. And what the IRS does is that they calculate your future income and your assets, and they come up with a number. They take that number and compare that to what you owe. Okay? If you owe more than you have the ability to pay, they compromise the debt. Okay? I'm serious. We have cases The biggest case I've solved with a compromise, and this is real, and this gentleman owed $1.6 million from a failed business, payroll taxes. He came in my office, big, strong guy, was crying like a baby. I ran out of tissue, like I'm sweating now. I ran out of tissue. So what happened is that he didn't have $1.6 million. We settled for $1,600. And if I'm lying, $1,600. Why? Because he didn't have the ability. When we added up his income and assets, that's what he had the ability to pay. I called him 2 years after that to do a testimonial. When he heard he said, "Oh no, Muhammad, what? They changed it?" I said, I just need you to do a testimonial. You're good. Everything is good. He didn't believe it happened when it happened, and he still didn't believe it. $1,600. But here's how it works. Let's say your income is $5,000 a month, and it really doesn't matter. What matters is what the net is. This could be $15,000. It doesn't matter. And your expenses are $4,900. I'm a lefty, so I got to bear with me in my writing. Okay. The difference is $100. The IRS takes this $100 and multiplies it by 12. That's $1,200. So from the income perspective, you can settle for $1,200. Okay? They take your gross income, they subtract out your living expenses, food, clothing, shelter, taxes, insurance, transportation, court order payments, student loans. They add all of that up, and if $100 is left, you can settle for $1,200.
Now, what happens if it's vice versa? Your income is $4,900 and your expenses are $5,000.
There's something I like you. It's something called currently non-collectible. But we still can do an offer maybe. That means that they won't ask you to pay any money. And then you can let the time run out. You see how you putting this together? In the very end, we're going to have a little session where you guys are going to solve the problem. I'm just ask a few questions. We're going to solve it. Yes, sir.
Is this formula applied to business and
Yes,
personal?
yes. From a business perspective, you take the gross income from the business, all of the business expenses. Actually, sometimes it's easier for business because there's no cap they don't cap out your transportation in a business. They're not going to cap out your warehouse expense. If your warehouse is $50,000 a month, they're not going to say, well, we only going to allow $40,000. No, your business expenses are used. So this same principle applies to the business, okay? Now, they may look at you personally to see what you could pay. After we calculate what the business can do, they may look at you personally. If the tax is what is called like a trust fund, like a payroll or sales tax, okay? So they're going to look to see what you can pay. But getting back to this, did I answer your question? Yes, sir.
Will they ever force you to liquidate assets?
They can do that. They definitely could do that. They do that when you are not smooth, when you haven't been responding, when you're not thinking ahead. It's a chess game. Mm-hmm. So you have to plan. You have to know what's coming. And you have to read the agent that you're dealing with. All right? Yes, ma'am.
I have too many questions right now.
Okay. Well, we have a question and answer. I'll be here as long as it takes. So this tells us that you can pay $1,200. This is what you can settle for. Then they add your assets. Assets are your home, your 401k, your IRA, your car. They add up your assets, all right? So let's say that you have a house that's worth $500,000. But you have a mortgage that is, let's call it $420,000. This is your mortgage debt. So the equity is $80,000, right? That's the way it looks like. But what the IRS does, which is good, they take the $500,000 and they take 20% off that because they know you have to have closing costs. So this now becomes, if my math is right, I'm a CPA, right? This is $400,000 minus $420,000. You don't have an asset. So it's the equity in the asset. Okay, it's not the asset, it's the equity in the asset. Okay, you may have a car, but what's the value of the car? What's the loan left? So they take the value, multiply by 80%. That's where I'm getting the $400,000. Subtract the mortgage. This is the asset. We have so many cases like this. A lot of people remember we were underwater. A lot of people underwater. So when you're underwater, you need to go see the IRS.